Everybody, it's Rob Keenster, host of the Freedom Report. This is your weekly market report for Tuesday, May 14th, 2024, halfway through May. It's going fast, and this year's going fast. We've got a lot of data to report on. We're going to talk about the Fed. We got a lot of stuff. I'm just going to dive right in. Let's jump into it. We'll do the economic analysis, a few stories, and then the gold and silver report as we typically do. What's going on with the economy? Well, that is interesting. As we look back at last week, pretty much what we're seeing is a collapse of the consumer. We had only $6.3 billion in new additional consumer credit after $15 billion last month, and I think at the end of last year, 30-something billion to round out the holiday season. Most analysts basically right now are coming out and calling the end of the consumer. The consumer is literally tapped out. They can't take any more credit. The average credit card balance is over $6,500 in the U.S. There isn't any more credit for people to take really at this point in time. There's a lot of financial stress going on. And as a result, consumer sentiment has collapsed. Last month, it was 77.2, which is about a mediocre rating. This month, it's 67.4. Consumers pretty much at their end of the rope and expressing that in the sentiment surveys. Initial jobless claims have spiked from 209,000, which was up over the previous month, I think, of 207. Well, this month they're at 231,000. So a lot more unemployment insurance benefits are going to be paid for people who simply don't have jobs. And wholesale inventories are collapsing as well. Wholesale inventories are collapsing because the consumers aren't buying stuff from the retailers and the retailers aren't buying stuff from the wholesalers. It went down last month at negative 0.4% wholesale inventories after being up about 0.2% the month before. So now we're getting an actual reduction in wholesale inventories because people aren't buying retail. And why would retailers buy from wholesale? If they're not making sales, well, they're not going to. This week, the producer price index, a measure of wholesale inflation, spiked. It's at 0.5% month over month, meaning April for March, and it's 2% up year over year from last year. So we're seeing a good bit of inflation work its way back into the system at the same time that we're seeing less demand and less consumer spending. Well, how can that be? How can we have less spending and less demand from the consumer and yet more inflation? Well, it's simply a function of the dollar. There are too many dollars, and that inflation is coming home to roost, even though GDP is not increasing. GDP recently came out, and it's 1.6%, which is not good. Basically, analysts are saying we're about to flatline on the GDP, which may mean that we go negative GDP sometime this year, and we get into more of that official recession territory, even though I don't think the current administration is ever going to want to say that we're in a recession, even if we collapse 50%. They seem to not ever want to tell the truth about the economic situation. But in any case, the numbers are glaringly obvious that we're headed for an official recession. I think we've been in a real recession for some time. But the nominal top line numbers that everybody relies on are screaming that we're slowing down, that the consumer is collapsing. Two of the analysts I read this week have basically said that there is a knock-on effect or a delayed reaction to the consumer collapsing because the consumer is 72% of the economy. Once a consumer collapses, it takes a few months, and then the banking system begins to collapse as companies begin to be overwhelmed by their debt as well. So the picture is very bleak. If we're really at the end of this consumer spend cycle and at the end of the dollar's effectiveness, and what we have coming next is going to be a really nasty recession. I don't know that we're going to make it through the election at the end of this year before that happens. So I feel kind of two ways about what's going on. Recently, Powell, at the beginning of this month, and the Fed said they're not going to lower interest rates until inflation comes under control. Well, I got news for you. It's not going to be under control. He did leave open the door if employment gets really weak, which it's starting to, although probably not at DEFCON level that he wants to lower interest rates. They may ease the interest rates a little bit if that happens. So they left himself a back door, even if we have high inflation, but really bad employment numbers, that they may, in any case, ease interest rates. But they're not going to be able to do it that much because once they get in the recession, remember, history says they need 5 percentage points of room to get out of a regular recession. I don't think we're heading to regular recession. We're heading to a big daddy. But in any case, I think that they're wanting to keep 5%. So that only gives them about 0.5% to cut this year, or until we get an official recession announcement before they start easing more on interest rates. So I don't expect them to do the 3 interest rate cuts this year. If they do, it's a sign of abject desperation, because they build up to over 5% interest rates so that they could have that room when the recession comes. So in other words, what it means is the Fed's stuck between a rock and a hard place and they're not going to be able to solve the issue. They're still trying to use their policy tools as if we're going to a regular recessionary, deflationary cycle, and we're not. So I think ultimately it's not going to work. I don't think the Fed can do anything right now to make this work. But in any case, I think they're going to try, but I think the readout is really bad. Here's an article from Alfredo Ortiz via Real Clear Policy. Quote from the article, the specter of stagflation has returned. On April 25th, the Bureau of Economic Analysis announced that GDP only grew by 1.6% in the first quarter of this year, well below expectations. The article goes on to note what I just said. Consumer spending on goods actually declined in the quarter as ordinary Americans are financially tapped out. The report also showed inflation remains stubbornly high, continuing a recent trend of resurgent inflation, running about twice the Federal Reserve's target rate. American small businesses are the biggest victims of the stagflationary economy, which is being weighed down by big government policies. This was the most important storyline coming out of this month's National Small Business Week. President Biden is claiming a small business boom under his administration. The reality is entrepreneurs grapple with a triple threat: a decelerating economy, soaring inflation, and escalating credit expenses due to his bad policies. So this analyst is basically saying the same things that I've been saying for months and months and months and months and months. Continue to read from the article. American consumers have a record $1.2 trillion of credit card debt. They are experiencing declining real wages and face a cost of living crisis. They can't afford to keep up their discretionary spending, which small businesses rely on to survive and to thrive. It now costs the average American family $12,000 more to enjoy the same living standards as before President Biden took office, according to the article. According to the article, since Biden's inauguration, wholesale costs for small businesses have risen 20%. To maintain their slim profit margins, entrepreneurs are forced to raise prices, alienating loyal consumers and reducing demand. Commentators and the media don't understand that there are only so much consumers are willing to pay for non-essential goods and services. Article continues to go on. Again, this is from Alfredo Ortiz at Real Clear Policy. Go read that if you want to get further into the numbers. More information about the corporate collapse. When you start to see this in retail, specifically discount retail, this is a leading indicator we're heading straight into a recession in the near term. Now, I realize we have been in one probably since the Great Recession in 2008. We never really got out in real terms, but we're talking nominal top line numbers that the government uses and that most analysts use. So we cover that. Walmart to reportedly lay off hundreds of corporate staff and relocate others, according to an article from CNBC published yesterday at 10 p.m. A quote from the CNBC article: Walmart is cutting hundreds of corporate jobs and asking more remote workers to move to offices, the Wall Street Journal reported on Monday, citing people familiar with the matter. Meanwhile, workers at the U.S. retail giant's smaller offices in Dallas, Atlanta, and Toronto are being asked to move to other central hubs, such as Walmart's corporate headquarters in Bentonville, Arkansas, as well as Hoboken or Southern California, the report added. Now, a lot of people aren't going to be able to pick up and move. They may have spouses at work. They may have other familial commitments, kids in school and stuff. So at least over the summer, that might be a good time to move, but who can afford to sell their house and buy new at higher interest rates? This is not a lot of people are going to be able to make this move. So more than likely, a lot of these people that work at these smaller office satellite locations for Walmart are going to look for other work. They're going to get laid off and look for other work. I know I've been a part of that when I was in corporate America, where one of the companies I worked for, a big company, did something similar. And a lot of people chose not to move because it's just too much inconvenience. When you've got roots down, you got houses and finance and school and family members and a spouse working somewhere. It's not easy just to move at the drop of a hat just because your employer wants you to. According to the article, Walmart will let staff work remotely part-time as long as they're in offices a majority of the time. The report said so. They're trying to be some flexibility. Credit to Walmart for that. Walmart employed approximately 2.1 million associates as of January 31, 2024, according to regulatory filings. The company has been making moves to shrink its workforce over the past year and has said in April last year that it expects about 65% of its stores to be serviced by automation at the end of fiscal year 2026. AI and automation destroying more jobs. Because why? Because the economy can't what? Keep the living wage up, keep people employed. This is this dollar system imploding. And the only recourse for big companies to maintain their balance sheets is to move to lower cost. Because why? They're burdened by debt and an economy that's crashing, and they're forced to lay off their biggest expense, which is always what? Labor and employee costs. something we've been talking about for about 15 years now, is finally starting to come to fruition. Looking at the markets, the Dow is up 122 points to 39,681. S&P 500 is up 23 points to 5,269. NASDAQ is up 115 points, shaking off all the bad news to 18,410. Oil has come down a little bit, but it's still trading at 78.45. In the bond market, we're having all sorts of issues. This is starting to get really bad, like it kind of did a year ago, but now I think it's getting to the same point, and it's going to accelerate through. Interest rates are going to spike up, which is going to make it really hard for the government to afford its debt. And we're going to at some point have sovereign debt default risk. We don't, there is risk there now, but it's become real and clear and present danger, if we use that language, in the bond market. Not quite there, but we're getting there. And it's going to be worse this time than it was in the last few years. The 2 years trading at 4.821%. It's down a little bit on the day, but it's still elevated from where it was, say, a month or two ago. Certainly from all that euphoria, everything's going to be great at the beginning of the year. And I told you in January, look out, it's not going to be. And by the end of the first quarter, we would know how the corporates are doing and how the consumers are doing. Now we're into the second quarter, getting all these information reports. And what did I say that has now come true? After the first quarter euphoria and the fourth quarter of all the spending on buy now, pay later and consumer credit binge, now all of a sudden consumers are tapped, corporates are panicking, inflation's up, the Fed's between a rock and a hard place. All those things I've been saying for the last 5-6 months are now coming to fruition. At the time I said they would, not because I'm Nostradamus, but you just follow the data. It's not that hard. The 10 years trading at 4.445. That's a yield curve inversion for those that may not know, haven't been watching the show, or need a little bit of a gentle reminder. When the short-term treasury debt is trading at a higher interest rate than longer term, i.e. the 2-year right now trading at 4.821 and the 10-year, the longer term, trading lower at 4.445, that's a recessionary indicator that has been right 100% of the time that it's existed, especially when it's existed this long. And I think we've had yield curve inversion now for something like 8 or 9 months. I have to go back and look. It's been almost a year. That's like 100% indicator. Recession, 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 blinking warning lights, danger, Will Robinson, that whole thing. Moving over to cryptocurrencies, Bitcoin is trading down today, $1,500. Look at the volatility in Bitcoin to 61,504. That's the time of the report. It moves so fast that the numbers I give you are never the same when you see them, but at least it gives you like a daily view. Every single one of the most popular cryptocurrencies I'm looking at on CNBC's chart are all red. It's all red today. They're all down about anywhere from 2 to 2.5%. XRP is down about 1.27. It's not looking good for the cryptocurrencies. They're not absorbing the news of risk and reacting positively overall, like some other risk assets are. And the stocks I don't count, because essentially stocks are a function of the amount of money printing. So stocks are always the worst indicator until it's too late and the collapse comes. Gold is up today, $19.73 to $23.58.24. And silver is again approaching 29, that critical level at which they don't, the market makers and the CFTC doesn't want silver to go above 30. Well, we're at 28.61 right now, up 33 cents. I expect a big slam down coming in the next week or two. Whenever silver gets really close to about 29.50, get close to 30, expect that slam down. That's been the pattern. Eventually, the slam down is going to stop working. What I documented for you, and we'll get to this more in the gold and silver report at the end of this show. Whenever you see silver get to 30, they have to dump a bunch of paper. Well, they dumped a crap ton of paper last 2 or 3 weeks ago when silver approached 30, and it didn't move it down enough. And now we're popping right back up to 29 again. So no, even though they're sitting at more than a 2-to-1, the bullion banks are sitting at more than 2-to-1 leverage short paper on silver, it's still not keeping the price down. So in other words, what they're doing to manage various aspects of the economy ain't working. It's not working really for anything other than the stock market. And the only reason that's working is because that's where all the money pumping goes. But eventually when that crashes, the stock market will be the last step. Stock and bond markets will be the last step. And by then, but that's the indicator most everyday people look at because they look at the mainstream financial media. Well, for them, it's going to be too damn late. They're not going to have any time to prepare. Should have been paying attention to gold prices since 2016, to the rise of cryptocurrencies, to the credit usage, to the problems with the sovereign and the consumer debt, the problems with the banking system we've been seeing for a long time. It's unfortunate that when you watch the mainstream media, they don't really emphasize those. So the average person's going to get screwed here. And I'm going to do an economic show in the next couple of weeks as we get closer to what I think is going to be hard times during the summer and even leading into harder times at the end of the year in the financial markets. Well, we'll save that for later, but I'm going to talk about um, financially how the middle class and specifically the baby boomers are going to get hit so hard and they're not prepared for it. And certainly a lot of you baby boomers in my audience know, because that's why you watch the show, right? You're doing your research, but you guys are in the vast minority, little baby percentage of the overall baby boomers. Baby boomers are going to lose a lot in this next recession. And I think a lot of them are going to maybe go jobless, homeless, lose a lot of their assets. It's going to be bad in that generation because they have half of all the wealth in American society is going to get hit the most because they're mostly in bubble assets. And when those crash, it's really going to hit the baby boomers. We'll do a show on that. A couple of interesting stories. AMC completes 250 million stock sale during a meme rally. Shares jump 100%. The memers are back in AMC and GameStop. So AMC and GME are surging. GameStop shares surge 130% in pre-market as meme stock craze returns. You know what this is? This is people trying to get return that are desperate. And a lot of people are piling into this to try to game the market to get some value. And because you can concentrate on just 2 stocks, you can do it. But what it is just more specifically young people, but a lot of people investing in stocks, trying to game the system and get money out of it because they're desperate, because they're not getting return anywhere else. This is all going to crash just like it did last time. And they're going to be bag holders, people that get in at the end of this little, game that's going on in these stocks. And this never turns out well. Well, it's back. And I think it's a sign of desperation. All right, let's roll over and get into the data portion where I walk you through the gold and silver markets. I'm sitting at the commitment traders. Let's do that last. Let's go over to the volume and open interest. So you can see here we have silver volume and open interest, muted volume there. Price is rising. Price rises when you have muted volume because it's more of a normal market. When you see these big spikes, this is when basically it's a tamp down typically of the shorts. Typically, most of the time, that's the pattern. I like to point that out. If you're looking at totals for the last trading day, 168,000 traded contracts here. Only 66 deliveries because we don't have a lot of contracts in May. So the trade is always bigger because you're trading a forward month. And unless you're at the beginning of the month of a really popular month, one of the 6 months with heavy deliveries, you're not going to get a lot of deliveries. So you'll have a lot more in this than your deliveries. And it just goes to show it's all paper games that moves the price up and down. But on lower volume, you have the price moving up. That's a pattern that we see. And I just point out these patterns so you know how to read them right off the chart. It helps you kind of get an idea when gold and silver may rise, at least looking at the current data. Can't always predict it out, 6 months. But this gives you an idea of how the market actually works. It does not work by physical trade. It does not work by your local coin dealer, your big online dealers. It does not work off the actual physical delivered in the industrial markets. It's a paper trade. And that's why I do this every single week. And I'll do it probably until we reach some sort of change in the commodities markets to show you guys how this works. It's so obvious at this point, how the game is played and why it's played the way it is. But we get new viewers all the time, and I want to do this every week so it's irrefutable. I want a living record of all the games and garbage that goes on in the commodities markets, especially the precious metals, so that it stands, so that people can go back and look at this over history and understand how it works. It's so important if you're going to invest in precious metals to know, because you've been given a grace period right now to get into the metals before the whole thing goes tits up, the whole rest of the economy goes tits up, okay? So to use, I think, maybe a British phrase, but in any case, we're going to go over it. So silver, 750 EFPs. Those that watch the program know that's exchange for physical. What the heck is an exchange for physical, Rob? You take a futures contract in COMEX, you go over to the OTC unallocated gold and silver markets, equivalent gold or silver equivalent position you have in COMEX over in the UK market, and you try to get exposure. Sometimes it's for price differences because we know that COMEX is the cheapest gold and silver market across the world pretty consistently the last few years. And so there is some price arbitrage where you trade one paper for another and try to make money on that. But they're also looking for physical. And if you want to pull forward a futures contract in the future on COMEX to get physical now over in the UK, sometimes you can convince people to do that. Doesn't always work, but I'm told a lot of that going on. Let's see. That date of the dominant month is July 2024, 136,000 contracts in silver. You've got some trade going on in September as well, a little bit going on in December. December will end up being the biggest month of the year for gold and silver. It typically is, both in trade volume on the paper and in physical deliveries. And it's kind of setting up. You already see people taking their December positions already on that market. That's Monday's data. Let's go to last Friday's data. We had EFPs of 255, total volume of 83,619, pretty healthy trading, some EFPs, not a ton of physical deliveries, 284. Again, the current month, there's not a lot to physically deliver, but I'm going to show you the month by month and yearly totals of gold and silver deliveries here in a moment once I get through the pricing data and the volume data. And I'm going to show you which months are delivering and how much metal is being taken off. I think it may astound you. There's a lot of metal coming off our markets, and there ain't going to be a lot left. And you guys, if you want to get it and you've decided to do that, do your own research. I'm not your financial advisor, consultant, financial advisor, accountant. That's my disclaimer. Got to do it every show. Not only protect me, to protect you, especially if you're new getting into this. Do your research. But at the end of the day, if you decided to get gold and silver, you might want to do it now, because the big boys are taking it all through the back damn door. Trust me. All right. Last Thursday's data, 174 deliveries. EFP 665. Now, these are 5,000 ounces of silver. So when you have 1,000 contracts, it's equivalent to 5 million ounces of silver. 665 is going to be closer to maybe 3 to 4 million ounces of silver that they're taking, where they can't get it immediately on COMEX and trying to go get it in the UK. Just to kind of translate that for you. Last Wednesday's data, 450 deliveries, healthy volume 162,000, EFPs at 165. Moving over settlements, the only reason I look at this is it shows you spot prices. This is where spot price determined. The intersection of the long and short paper demand, which creates a price like it does in any market. That's how it works in the derivative markets. For Monday, we were down 6 cents on silver. For Friday, and this is a change column we're looking at right here. This column right here, if you guys can see. Up 14 cents Friday. Thursday, up 77 cents. Now go check your spot prices on your spot price apps, and you'll see it mirrors this almost exactly. This is where the price determined, ladies and gentlemen. It's the way it's always been, the way it will be until that market breaks, which we may be getting closer to. This is gold. I changed the screen on you. Now you see more elevated interest in gold. Why? More shorting for the most part. More interest and more shorting. Why? Before a crisis, gold goes before silver. You're going to see elevated volume and deliveries in gold before you see it in silver. Trust me, this is the way it works, especially a really big impending crisis. Why gold is used as money at the central banks, where silver has been more commoditized. So they're going after the money first to stabilize the central banking system, the commercial banking system. Silver is second because it's the little brother to gold, and it's considered money, but only after gold is either wiped out or it follows gold in terms of its monetary demand. Silver, in between those periods of heavy gold monetary demand, trades more like an industrial commodity. Just explain that for people who don't maybe know the difference between gold and silver. Those of you who've been watching the program for a long time, you know, and that's okay. All right, on gold, elevated volume, expect more shorting. We'll get to that in a minute. At close, 522,331 contracts as of Monday's data. A change down to 736. Where are they going? They're rolling into August. You see this last number here in the change column. 18,000 contracts got added. 26,000 have been pulled out of June. So overall, a negative net change. Also, less overall interest in gold, a little bit from an overall perspective. A lot of it has to roll in contracts and various positioning in the parties. I wouldn't worry too much about that. The number's not big enough to worry about, but just pointing it out. Okay, look at this. EFP's 38.50 in gold. That's 100 ounce gold. So you multiply or move that comma, I'm sorry, 2 places over. So it's 385,000 ounces of, 3,850 contracts times 100, move it 2 spots, 385,000 ounces of gold. Not as much gold, but gold's worth a lot more. So that's still a very high number. Total volume 306,520, lots of interest. That is a crap ton of volume. Going back to Friday's data, we had EFPs in 1903, very heavy volume at 529,367. This is what I'm talking about. These numbers are a graphical representation of what? This number here. And block trades, we'll get into block trades in Clearport later. I'm beginning to have a little bit more interest in those because especially Clearport's been elevated. So we're going to add that to the presentation one of these days. But we'll do that eventually. But you're seeing people are wanting the gold physically. That's what this data tells you. A lot of short paper being dumped to keep that gold price trading in a range. Well, they take it out the back door. And we'll get to deliveries in a minute. The EFPs are trying to get delivery in London. The actual physical deliveries on COMEX are where they're taking it out of COMEX. They're trying to get it both ways. Go here, go here. Get the gold, get the gold, get the gold. Keep the price down, get the gold. Keep the price down, get the gold. That's what's going on. Gold from London, gold from the US. Gold from London, gold from the US. Keep the price down, take it out the back, the physical out the back door. That's how it works. Easy, easy. EFP 63.87 on Thursday and total volume of 305. Woo, people want the gold, baby. 526,888 at close volume for Wednesday, 4,034 repeat. You get the picture. I'm just illustrating how the darn thing works, so you know what they're doing. They're still in the gold out and the silver out the back door, either from the US or the UK markets. A lot of it's probably sovereign going over to China, India, the BRICS nations. A lot of it's wealthy people seeing what's coming and they're going for the gold, baby. In addition to industrial demand. Here is the year-to-date delivery notices for the COMEX, which is on the NYMEX report. If you want delivery notices, just Google, or I prefer Startpage, uses Google's API with privacy, startpage.com. Look up NYMEX metal deliveries, and you'll get this report. And you got to scroll down to gold and silver because it also has copper and platinum, palladium, all that stuff in there, all the metals. But here you can see this is the months at the top. Last December of 2023, January, February through this December. So you get a 13-month report. And they always have December on there pretty much for the fact that December is always the biggest delivery month in gold and silver. So it makes sense. And some of the other metals too. Well, last December, you had 15,134. That's considered the biggest single delivery month in gold and silver. And right down here, 15,134 for December of last year. Read this column. Well, you had 20 in February, you had 18 in April. And about every 2 months, you get heavy deliveries. That's the pattern. 6 months of heavy delivery months, 6 months of lighter. And so you can see that this year, the heavy delivery months have been bigger in February and April than the biggest delivery month every year of December, meaning more gold going out the door than you normally see in any given year off the COMEX, actual physical deliveries. What does that mean? Everybody's taking the gold, and they're taking it more than even the biggest month every year of December. Okay, why? Because the financial reality I tell you about manifests in people taking the damn metal because they're afraid. And the central banks need it, and the sovereigns need it, and people need it. And we're not getting a lot of gold and silver sales in the US, but the rest of the world's buying it like mad, baby. And they're taking it off our exchange, draining our coffers on our exchanges because they know what's coming. And that's why I'm showing you the report. In May, a light delivery month, we still had 1,934 deliveries. Look at this number at the bottom. Let me blow this up a little bit for you guys. There we go. 1,934 here at the bottom. That's gold. Let's roll down to silver, shall we, ladies and gentlemen? There's copper, micro gold, palladium. Silver is usually at the end. Here we go. 5,000 ounce silver futures. I don't look at the micros and the minis. I look mostly at the big one. That's where you see most of it because you're talking 5,000 ounces. Same thing. In December, we have of last year, 4,051, the biggest delivery month for silver typically and gold, the one that they share together every year, end of year. 4,051 contracts at 5,000 ounce silver is about 24-ish million ounces. You multiply that out. We'll look at the big delivery months so far, March and May. Now, they're different for silver than gold. So it's not February and April. It's March and May in silver. But look at it, 54.87. Well, okay, March this year had more physical deliveries off of the COMEX, the U.S. markets, industrial markets, than December, which is always the biggest delivery month in any given year, typically, the typical long-term 20, 30, 40-year pattern. And the next big delivery month in silver has been May. And guess what? We beat March, and we're not even done with May, but most of the deliveries at the beginning of the month. So you may get 6,000, but you're probably just under. That's about 26 million ounces of silver, something like that, give or take. I'm just in my head. Yeah, people are grabbing silver like mad, baby. They're grabbing gold. And they're grabbing silver while we go to the Commitment of Traders report and look at who's holding the shorts down, the price down so they can get it cheap and steal it right from under your nose. The swap dealers, the bullion banks, are more than 2-to-1 leverage short in silver when a couple of months ago they were dead even long in shorts. What does that do? It holds the price down. How do I know that? Well, one, the Office of the Comptroller of the Currency report, which tells me who the banks are and what their derivative positions are. Okay. And also this little report down here from the CFTC on the same report that says the 4 largest traders are almost 33% short. That would happen to be mostly the swap dealers. That's the biggest position. And you got producer merchants when you get in the top 8, which is legitimate hedging. But still, there's basically 4 entities in the entire U.S. market, according to the Office of Comptroller of the Currency report, which I showed you a bunch, and this, which I show you every week, which is holding the price of silver and gold down. In this case, we're looking at silver, while they steal it out the back door. As you can see on the delivery report, you get how the game works. They know what money is. And on top of, for silver, it's money plus the most critical mineral in earth for us to have our current lifestyle. They're stealing it out the back door while the bullion banks hold the price down. It's so blatantly obvious. I don't know how else to put it, but that's the way it works. Let's look at gold. Do y'all notice that the same thing, 68,000 contracts to 73 is not quite a 4-to-1 ratio. 36.4 top 4 traders, 52.7. Top 8, even more concentrated in silver, 46.9. Gold, 52.7. What are they doing? Holding the price down to what? Steal the physical out the back door. Okay. I don't know how else to say it. Now, from a weekly perspective, this gets printed week to week, and it's a week behind. We're May 14th. This is May 7th. That's just the way they print it, because I don't really want you seeing what's going on in real time in terms of the positioning. Okay. So the data you look at here from the CME group is recent, even to the day, and sometimes to the half day. The CFTC gives you a nice week to 10 day delay. So the people forget these numbers by the time they go figure out why these numbers are moving by looking at this report. A little sleight of hand. It's also because CFTC is horrible about collecting data. They don't even have access to their own data feeds by their own admission. Last year, I showed you a report on that. They get a lot of it from the traders. So I don't even know if the data is accurate, or the traders are really reporting. Maybe, yeah. Anyway, not a lot of audits on this stuff. So I don't really have super confidence in the numbers. I think there's probably skullduggery going on in the background. But even the printable numbers they print, it's blatantly obvious what's going on. But for the last week, there hasn't been a lot of movement. You don't see a lot of changing of positioning. In other words, they've already done their big short in gold and silver. They've done their big short in gold because there's only this much movement by the bullion banks. Not a lot of movement overall. The managed money had a lot of movement. They were dropping longs and going short. Well, that just means the price is about to rise because the bullion banks are dropping shorts and going long. Guess who's going to make the money? Guess who the smart ones are? It's the bullion banks. They have all the market data. They produce all the reports that gets these people to take a position in it anyway. You get bankers' reports. Who are the bankers? The swap dealers. They front run it, give old information to everybody else in the market, and then trade against them and make money. That's how they can do their shorts and longs and make money all the time. It's not hard to figure out. Same thing in silver. Not a lot of movement this week. So they've got the big short, although I think these numbers, by the time we see the next report, are going to explode. Because why? Because gold is approaching 2,400 again, and silver is approaching 29. And when they get close to 2,429, you're going to see massive shorting right in this column by the swap dealers. I'm putting it right in front of your face, so it is so obvious that you guys see it, because we need to prepare. We're running out of time. We are completely running out of time. A little bit on the legislative report for Citizens for Sound Money, since I'm a board member there. We're trying to get legislation passed for gold as money in various states. Missouri, now we're helping out in Missouri. We're not the lead there, but we're doing a lot of lobbying work and spending money there. We did in Florida. We'll come back in the next session. We're going to do Texas next year, and we're also doing other things. There has been a lot of progress in Missouri. We're trying to get it pushed through. There's a lot of support for it. There's some resistance by certain concentrated position parties, which I don't know, may have got donations from certain other parties who don't want to see gold as money, but we're putting some monetary and political pressure. Now, what we need for you guys is in Missouri, Florida, Texas, all these states that are wanting to pass this legislation, pick up the phone and call, send an email. If you have time, drive to your state capital, let your guys know. The political pressure you guys put on the system can help us develop alternatives for you that allow you to use your gold and silver as money and allow you to stay out of the CBDC world, which is, I've always said, it's digital slavery. You don't want to go there, but you guys have got to get active. Please help us be active. Just pick up the phone and tell your state representatives what you want, and don't stop. And if you can show up in person, that has a tremendous effect. If 1% of Americans showed up at their capitals over the span of a couple of weeks and said, we want honest money, you would get legislation passed and boom, because the politicals want to get reelected. And it doesn't take many people showing up in person. It takes a lot more emails and phone calls. If you can show up in person and say, I want you to pass the Constitution Money Act in this state, and they say, what the hell is that? Well, go look at C4SM, go look at these other states. Go look at these other, the Sound Money Defense League is also doing it. Other groups that we're working with across, big grassroots organizations across the U.S. and doing this in 25 states right now. It helps. It really helps. All right. That's going to be the report. I'm going to summarize for you guys. Collapse in consumer ability to buy anything, even on credit. Consumer sentiment crashes because they know the crap's hitting the fan. Jobless claims way up. Economy weakening, wholesale inflation, which means retail inflation that you're going to pay is coming. The government's between a rock and a hard place, Fed between a rock and a hard place. They want to ease and they can't. And even if they do, they can only do a little bit because they got to save it for the recession. We're headed to recession. The yield curve inversion is pointing to it. The stock markets are the only thing that most people follow. and they're the worst indicator because they're last to crash. Everything else is screaming recession, recession. Bad shape. The gold's being stolen out the back door by other parties. I say stolen. It's being taken at lower prices because the derivatives market wants to down price it while everybody takes it, whether it be another country, rich people, this, whoever. They're all getting the gold. Everybody scramble for gold while they're keeping the prices down. Big collapse in the banks coming. A lot of analysts saying this is the end of the end of the end. I personally don't think we're going to make it the end of the year before the collapse starts. We may have 2 to 3 months or 5 months if we're lucky. I don't think we make it through the election and Christmas. I don't see how consumers can spend. I don't see what any policy that the Fed or the government does is going to save it. The money printing's causing inflation here, even though we're deflating as an economy, which means it's all being shoved back at us from all these other people that we exported inflation to before. The euro dollars are coming back. We're in bad shape, guys. You don't have I mean, when I say you don't have time, I mean, you don't have time to prepare. And if you ain't preparing now, you may be screwed at this point. You got a little bit of time left. I don't want to discourage anybody, but my goodness. That's it. That's a weekly market report this week. Thursday, I got a really interesting video. I'm going to talk about the advances in technology that are going to build potentially a very controlling digital economy. It's going to control you in a lot of ways. I've got some information on that. And then next Tuesday, we'll do the weekly market report again. That's the economic one on Tuesdays. And then next week for Thursday, I've got an interview scheduled, as long as, knock on wood, that goes through. We'll have a very interesting returning guest. I haven't been on the program in a while. It's going to talk about freedom from various angles and what's going on. He's really well connected to what's going on underneath the surface of things. And we're going to get a good report on the state of our freedom, politically, culturally, in the schools, all which ways you can measure outside of the economic aspects next Thursday. This Thursday, more on the electronic digital system that's being built around us. Next Thursday on what's going on behind the scenes, politically, culturally, in schools and that type of thing. Assault on culture, those type of topics we're going to talk about. So stay tuned to the channel. We got a lot of good content. Thank you guys for supporting us. It's been Rob Kientz at the newly named The Freedom Report. Thank you guys for joining, watching the video and everything. We're going to be right here with you through thick and thin. We're not going anywhere. Thanks for supporting the channel. Until next time, Rob Kientz, The Freedom Report.